All right, so the US market is in bear territory, meaning it's down more than 20%. Canadian market is down 10%. Inflation is crazy high. Central Bank of Canada and the Feds are hand to hand to increase their rates like there's no tomorrow. Sounds like we're gonna hit a market crash, doesn't it? So the best thing to do should be to wait in cash or at least have a good cushion of like 25 or 30%, right? Well, this is what we're gonna look at it today. We're gonna look at why you should be waiting in cash and maybe why there's a better opportunity over there than just waiting and hoping we're gonna have a sign from the market that we should go back in. Dividend investors, bonjour. My name is Mike Giroux. I'm the founder of Dividend Stocks Rock, and I'm also the author of this YouTube channel where I help you to invest with more conviction so you can enjoy your retirement. Especially if you're retired right now and you're looking at this market that is completely disgusting, you're thinking, man, I've worked my entire life, I have all this savings, and now I cannot work anymore. I'm retired, so I want to play golf, I want to go to the restaurant, I want to enjoy my life. But I cannot do that if I'm losing $150,000 in the market right now, right? And I get that. Losing money sucks and it hurts and it's complicated to get back in the market as well. So if you're losing 10%, you need 11% return. But if you're losing 50% as it happened in 2008, you need to double that money. You need an investment return of 100% just to recover what you lost. So if you're retired today and you're counting on that investment portfolio to generate enough income to live, you probably think I might want to stay in cash and wait to see what's going to happen. So all the great reasons to wait in cash right now. Well, the first one is obvious. It's a bear market, man. So we're going to continue to lose money and chances are it's going to go down even faster. So we're all afraid of fall. We all know that it happened, like many bad crashes happen during fall period. So we're thinking maybe the earnings are not going to be that great and maybe the economic stats are going to be worse. And I don't want to be in that train that's going to derail, right? And most importantly, if you're in cash already and you're thinking, wow, now the market's going sideways, I'm waiting for opportunities. Sometime at some moment, I will have this key where I can invest and make a ton of money. So we're all thinking about buying low and selling high, right? So if you sold after the pandemic recovered, well, then you're probably just waiting for that moment to happen. The problem is, it may not be that obvious. So let's take a moment to go back in the last financial crisis of 2008, where we had the perfect scenario of a market crash followed by that bear market that took about 4 to 5 years to recover. So let's go back in 2008 and see what happened after that. The perfect market bottom was in March of 2009. So roughly the market went down from 50% from its peak level in 2008 all the way down to March of 2009. However, if you forget about the first part of that graph and you look at all the other three market indicators, you're going to see that it wasn't obvious. So first, GDP. So US GDP, the economic growth of the country, was not going anywhere. In fact, it was still in recession territory. It was really hard to get convinced that the market is booming again. And then you might think, oh, I'm going to wait for a few more quarters to get more information. Then you look at unemployment rate and you're just looking at things, you know what? Actually, things are getting worse. And if you remember correctly, in 2009 and even in 2010, when numbers started to get better, a lot of economists told you, well, unemployment rate starts to get better because people are just discouraged and they stop looking for jobs. If they stop looking for jobs, they're out of this graph, they're out of those statistics, but they still don't have a job, right? So it was getting better because people quit looking for jobs, which is even worse, right? And then consumer sentiment going nowhere again. So basically people are telling you, I don't have a job, or I'm not even sure I'm going to keep my job for the next 3 months, so I'm not going to spend any money. So it reflects on the GDP, it reflects on employment rate, and it reflects on consumer sentiment. However, if you had the guts to invest in 2009, you made an amazing year. And after that, well, you were set for 10 years of bull market. However, all the economic data were telling you the opposite. They were telling you to wait. And there's the problem. The market, yes, it's looking backward about economic stats, but it's also projecting numbers in the future. So by the time you realize that the economy is going back, it's been a long time that the market, so hedge fund guys, pension plans, fund manager, they all took the bet that the economy is about to take that turn in March of 2009, and they started to buy already. So they participate on that bull run very early while you were still waiting because you were looking backwards. Now, let's take a moment to look at today's stats. So today we're in some kind of like a weird recession. By definition, 2 consecutive quarters of declining GDP, so basically the economy that is slowing down, equals a recession. But now the government say, yeah, well, I kind of have a different definition because unemployment rate is super low and people are still buying stuff, and we have like all those economic indicators telling us that it's not really a recession. I mean, I like to keep things clear and straightforward. So in my opinion, the US is in recession. I agree, it is a strange recession considering that people have no problem having jobs and they can still put a lot of money aside. So as you can see, consumer sentiment are not that great, but it's not great because people are just worried about inflation and they're worried about all those bad news. But they're just saving money right now because they have a job. So instead of having a problem, it's actually a good thing. They're paying down debts. So they're getting ready for a real recession if they ever lose their job, and they have a good cushion. The thing is, whenever people start realizing that they're going to keep their job and they can buy this new car or they can go on vacation, they already have the money there. They will not need more credit to spend in the economy. They will be ready to bring that cash flow and to boost the economy right away. So what I'm telling you right now is, maybe we're going to have a market crash in the following months. Maybe the bear market is going to last for a few years, but maybe it's going to turn around very quick. And in either case, waiting in cash will be incredibly difficult and not a successful strategy. So I'm going to give you my trick to invest that money without getting hurt or burned by a market crash. So here's the thing. The first thing that you should do is to build a buy list. A list of stocks that you love, that you have researched, that you're confident that will increase their dividend in the next following years. Company that with robust balance sheet, all-star stocks. Actually, have created this kind of list, which is called the Rockstar stock list. I've used Dividend Stocks Rock Stock Screener and all the analysis that we have, and I've built that for both Canadian and American. So you have the 2 markets, you have a bunch of lists and a bunch of metrics that you can play around and identify the stocks that you love, and that shows very strong metric for the future. So just hit in the link description below. You can download it. It's completely free. It's being updated every month, which is kind of cool because you'll always have updated information. And with that buy list, what is really important to do and now that you have that buy list, here's the fun part. You will divide your cash reserve in 3 segments. The reason why I mentioned 3 is because I want you to consider investing 1/3 right now. So we're in the middle of the earnings season. So you look at the recent earnings, you validate your research and see if my investment thesis works with this stock, and then you invest right away, but just 33% of your cash reserve. Then you wait for another 3 months. Another quarter comes in, you can validate if the story is still good, if your investment thesis is still on dot, and then you invest another 1/3 of your money. You guess what? What's going to happen in 3 months after? So the following quarters, you're going to do the exact same process and invest the rest of your money. Why I suggest to invest everything between 6 to 9 months? Quite simple. If you look at past market crashes, not bear market, but market crashes, the market will crash within 0 to 6 months. It's relatively fast. Sometimes it takes up to 9 months, but after a big crash, what is usually happening is either a V-recovery as we had with the pandemic crash in 2020, so it goes down and then goes back up, or there's a fatigue. So what's happening is nothing. The market goes up and down, but there's not really money to be making. There's not much money to be lost. And it's just in a fatigue market, and eventually it's going to go back up later on with some kind of events or better economic data or better earnings results. If you invest during the market crash, you'll be averaging down. So every time, if the market is going down every 3 months, you're putting new money in. So you're getting closer and closer to the market bottom. So that's the first scenario. Second scenario is maybe we're already done with the bear market and we're already at the bottom of the market and it's going to go back up. So then you'll have your money working for you already a little bit at a time, but you'll be following a plan, a clear plan, and you don't have to wonder, yeah, but there's that economic stat that just happened. I'm going to wait for the Fed. I'm going to wait for the Central Bank of Canada. I don't know what's going to happen. There's election coming up, whatever. Well, then you follow your plan and you invest and you benefit from that bull market. Third scenario, we're in a fatigue stage or we're going to get in that fatigue stage in a few months. Well, then you're just buying dividend growers that will continue to pay a nice yield and will increase their dividend payment every single year moving forward. So in those three cases, you win. Not necessarily at short term, but over the long haul, you'll have your money working for you and it's going to be invested in a similarly good timing, so you'll be a winner. Again, if you want a good starting point for your research, download the DSR Rockstar list. It has everything you need in terms of metrics and great quality companies on both market to help you getting started. And I hope that you have enjoyed this video. If you know someone that has money on the side, forward that video to them. I'm pretty sure they're going to be happy to have some kind of like a plan or a strategy that they can look at instead of just wondering and waiting for those metrics to happen. Because if you wait, you'll be late. So give me a thumbs up. Go in the comment. Let me know what will change your mind about the market if you're waiting right now. Is it economic stats? Is it a special event? Is it like earnings? Let me know what makes you change your mind to stay, I'm going to stay in cash or I'm going to stay invested. Don't forget that next week we're going to have another video on Thursday. And until then, stay invested.